Recording in progress.
Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 128th CP program organized by AASP of ICI this year. Today's our 128th program, and this is in the form of webinar. And today's topic is again very important: key considerations in the audit of shared service center. And in order to tackle this, we are having our very learned speaker, C. Abhishek Gupta ji. So on behalf of AASP of ICI, I extend to you a warm welcome on this 128 CP program organized by AASP. Welcome to you, sir. Namaste. I also welcome all the participants of today's webinar. And before we formally start our today's webinar, it is my proud privilege to share with all of you the brief profile of our today's learned speaker, C. Abhishek Gupta ji. C. Abhishek Gupta ji is a chartered accountant from India with 18 years of experience. He is a co-founder and partner in Pelion Services in assurance and advisory practices. Abhishek ji is a transformation champion with almost 2 decades of experience in global assurance audits and advisory services, with a wealth of knowledge and consumer insights of serving clients globally. Extensive internationally experience of working across North America. Abhishek ji was, as far as his last consignment was concerned, his last consignment was with E&Y more than 10 years. When he was a part of core E&Y leadership team, he has set up the offshore assurance practices for E&Y North America, the biggest practice arm of E&Y Global. He pioneered it in the development, developed the business, and set up high-performing team of 1,500 professionals. He was being awarded with the prestigious E&Y Golden Bee Transformation Award and Emerging Leader Award. Abhishek ji carries a diversified experience of working as a finance controller with TMAS holding more than 230 billion bound fund of Singapore government. He has also worked with PwC for 5 years in assurance practice and successfully led audit for the Fortune 100 companies. He is passionate for education, skills, and technology advancement. He sits on the advisory boards of various prestigious institutes covering 50,000 students. He has delivered so many lectures, so many webinars, so many virtual CP meetings at various forums of Institute of Chartered Accountants of India. During the COVID time period also, he has delivered so many online lectures also for the benefit of the members. Still, this is very vast. So without wasting much more my time, I request our today's learner speaker, C. Abhishek Gupta ji, to deliberate on the topic and enlighten all of us on various intricacies and audit considerations on shared service center. Over to you, Abhishek ji, please.
Thank you, NLG, for a warm welcome and a big introduction about myself, I think. And thank you for the ICI committee for again inviting me on a topic which at least I live on a daily basis, because I myself kind of comes with a pretty strong experience in the offshore services, and has been doing this for almost a dozen of years now. So I think and that to kind of doing it in our particular services, it makes all the more relevance for us. So it's a very interesting topic, given the kind of a pick what we have in terms of topic about the shared service centers, the offshore centers. And I think in the last 4 to 5 years, it has kind of picked up quite a well as a topic of deliberation, as an area of interest for a lot of people to kind of really figure out global opportunities and work with these kind of an offshore centers. And interestingly, when we kind of started about when these offshore centers started a few decades back, they were predominantly into the finance and accounting and IT services. But of late, we have seen in the last 1 decade, there has been a significant upsurge in terms of these shared service centers coming in our particular field, which is audit, assurance, your internal audits, advisory, technology risk, and so on. So I think that kind of really helps us out to build up our conversation for the day. I have got a small presentation which I need to kind of present. And Anilji, confirm once the slides are visible. Is it visible, Anilji?
Yes, sir. Fine, sir.
Okay, perfect. So great.
Yes, sir. Yes, sir. Fine.
Thank you. So I think the way, at least I have kind of carved out my entire discussion for the next 2 hours is going to be touching upon what exactly do we mean by shared service center. What is an overview about the shared service centers, the benefits, how India as a country is kind of positioned within the shared service centers. And then slowly and gradually, we will transition into the key audit considerations, which is a key aspect for our discussion for the day. And we'll talk about the considerations which are important and critical right from the planning stage to the execution stage, and then to the audit conclusion and the documentation. So on this, without taking much time, I'll kind of go in terms of the overview in terms of what all topics we will be covering. Like the way I kind of mentioned, we'll talk about overview of a shared service center, the ownership model, so that at least we understand that how different types of shared service centers are there in the global market. How's the landscape position at this point of time in the global markets, again, where India as a country is kind of positioned. We'll talk about the possible misstatement areas, so which I normally call it as a key focus areas in the shared service center. The planning procedures, the specifically very, very high level key considerations, what we need to take into consideration, take into kind of account while we are auditing the shared service center. Some major financial statement captions in terms of what all areas you need to kind of take into overview when we are kind of auditing the profit and loss account, the balance sheet items, and so on. Risk assessment, we'll talk about key areas, the assertions around those areas, and how risks needs to be identified and mitigated. The entity level controls, we'll also talk about the key substantive considerations, again, for very, very specific areas, which are very pertinent to the shared service centers, and the general audit documentation. However, as we kind of progress and we kind of get into the thick of the things, you will see that majority of the things are very, very common, barring a couple of different aspects, but the scenarios are fairly simple. It's not as complicated as you would have been kind of seeing in multiple other industry groups. But it's a very interesting landscaping in terms of how the shared service centers are being kind of structured, specifically from a revenue model standpoint. So we'll talk about those revenue models in detail as well. So moving forward, I'll just give you a kind of an overview about the shared service centers. The traditional functions, as you know, which we have kind of, I was kind of highlighting earlier as well, has been predominantly in the finance and accounting space, HR, payroll outsourcing, you would have heard, and information technology. A lot of IT, the entire boom started with the finance and accounting and the IT outsourcing probably in late 80s and 90s. So, or late 80s and early 90s, and slowly and gradually kind of picked up into the payroll function, the human resources support, and the administrative functions, the support functions, so whether it is operational support or the preparation of some administrative documentation and others. Over the last few years, there has been a kind of an emerging trends in the marketing functions. So we have been kind of seeing a lot of marketing related work is kind of getting so-called outsourced or offshored, and enterprise analytics. So a lot of analytics based functionalities are now coming in play, and supply chain is becoming a big thing, considering that specifically after the boom of the e-commerce, there has been a significant push on the entire logistics and the supply chain functions. So this is becoming a big avenue for the outsourcing or kind of setting up the shared services in the different parts of the world. As I kind of mentioned, since majority of us are aware that in the last decade or 12, 15 years, we have seen a significant push in terms of the offshore centers or shared service centers or the captive centers for the public accounting work as well. When we kind of say public accounting, it covers your audit functions, your risk advisory, your mergers and acquisitions, transactions, everything what we do under an umbrella of being a CA or a CPA firm. So it got started with the big four initially. Now, after the big fours, the big six and the rest of the other, lot of multiple CPA firms are kind of coming on this route. So it is becoming a big scope and a big opportunities for our new chartered accountants, people who want to kind of get some exposure on the international financial reporting. So whether it is a US GAAP or IFRS, and for the folks who want to kind of get an exposure to kind of work in the US market. So, and I myself kind of come with that kind of an expertise, so would be happy to kind of take up some questions towards the end in case if uh, any of our member who is a practicing chartered accountant or any of our aspiring member who wants to be part of these functions want to kind of ask anything related to these models. If we talk about the value proposition, there are two aspects which I normally kind of talk about is the overall value creation and the value preservation. So we'll kind of talk from the bottom of the pyramid and then we'll go to the top. So if we kind of look into the bottom of the pyramid, it talks about the reliability. Reliability is nothing when you kind of set up these centers, there is an offloading of huge transactions, there is an offloading of huge data processing, there is an offloading of a lot of the heavy lifting of the work gets transitioned to these shared service centers. And the idea and the objective is to kind of bring a lot of effectiveness because they operate in a very set processes, set environments under which the entire processing of the data, under which the entire processing of the our entire analytics is being performed. So from that perspective, there has been a lot of effectiveness which is normally being observed in the shared service centers. Cost reduction, I think that's a given, considering that majority of the work which the shared service centers is with the perspective to kind of reduce the overall cost and to kind of manage the talent as well. So if we talk about like 5 years back, it was more of a cost arbitrage model when it all got started. But in the last 5 years, it has slowly and gradually transitioning from a cost arbitrage to a talent arbitrage. Because given the shortages of the people across the world, given the flexibility in terms of how the things have been working specifically in the remote environment, I think it is making it much more easier for the organizations or the global companies to look for these shared service center models. Quality and compliance, considering it works in a very structured environment under the kind of under defined processes. So ensuring quality and compliance becomes much more easier and relevant. So that works out very well to kind of ensure the overall reliability and the trust question in terms of the data which gets processed from these shared service centers, brings efficiency, it is cost effective, and then on top of it, it also ensures the right quality, which is the paramount. In terms of simplification, the simplification is rather more easier because of the expansion capacity which the shared service centers provides to the organizations in the global market is far more higher in comparison to if one has to set up their own center or they have to expand their own teams. So from that perspective, expansion is much more easier. The overall reduction in the efforts is there from the organization standpoint. And the idea is to kind of bring in efficiencies, and that is where this entire process brings in the efficiencies as well. Insights, over the period, it started with the value preservation, and then now it is kind of getting into value creation, where now these centers have matured enough to provide a lot of financial insights, which is helping the organizations and the C-suite and the board to take some critical financial decisions. So there has been a lot of analytics and a lot of data which goes behind it, or which is now being processed in these shared service centers, which helps the decision makers to take those decisions. So yeah, that's a kind of overview in terms of how shared services centers are being structured, what kind of a value they bring it on board. Ownership models, we can kind of go as deep as we can, but just to kind of give you a reflective view, typically you would have heard multiple nomenclature, shared service centers, captive centers, outsourced, offshoring, this and that. So just to kind of bring some more clarity in terms of how the shared service centers are being structured from an ownership standpoint. One is the captive center, the second is the outsourced center. Captive centers are simple to understand. They are the centers which are normally being created as their own self-support centers. So for example, in case if say American Express has set up their big captive center in India, and their objective of American Express captive center is only to support American Express. Similarly, in our world, the big fours have got their offshore centers in India and different parts and a couple of other countries of the world. And those offshore centers are only limited to support the parent or the main entity. So, and these centers can be in offshore location. Offshore location means that if we are working from India for the US entity, then we are an offshore entity for the US entity. Nearshore, in case if somebody in North America wants to kind of get a support from Mexico, so it can be considered as a nearshore because Mexico shares the border. Onshore means that in case if we want to kind of figure out the optionalities which are more cost effective, which are more talent effective within our given set of geography, then that means onshore. So, for example, in Americas, a lot of onshore centers are there in the southeastern part of America, which is called Florida. In Florida, there are a lot of onshore centers which are available and which are operative. So, but if we look into the overall segregation of the centers, the majority of the work gets done out of the offshore centers, where in India, Poland, now Philippines, and a couple of other countries are coming up big time. Nearshore, it's being done just to kind of manage some kind of a business continuity. And the second thing is to kind of ensure that they get the benefit of the time zone and the language support. The third is the onshore. I think onshore is in their country, so kind of supports obviously the timing and the language. The second thing is uh, the implementation of these centers is relatively slow because your parent entity is setting up their own captive or own support center. So the entire life cycle of setting up the center is fairly slow in comparison to an outsourced centers, and we'll talk about outsourced centers, because you have to set up the entire function, you have to kind of hire the entire team, you have to run the operations, you have to kind of see what is the best working model, what is going to work, what is not going to work, and so on and so forth. So there are multiple amount of challenges which are associated with the captive center in case if the company is setting up their own captive center. But having said that, once it gets established in say 2 or 3 years time frame, it becomes a kind of a self-supportive and a self-sufficient center to kind of support the entire global operations of that particular organization. And at times, there is a captive center which is being set up at the process level. So somebody is kind of setting up only to kind of do their accounts payable transactions processing from the India, and that's going to be a captive center only for accounts payable. Some of the organizations set up their centers for major processes. It can be accounts payable, it can be revenue, it can be your your AR collections, and the others are where they kind of do all these the technological support. You have got your operations support center, you have got your IT support. So you centralize your IT support completely in some part of the Eastern Europe, and you say that everything is going to be done out of these centers. The that's very subjective in terms of the nature of the business, in terms of how they want to set it up. In terms of moving to the next part, which is the outsourcing centers, these are majorly based in the offshore locations. So India again is a big hub for that, and it all started with the IT boom with Infosys and Accenture and all, wherein they set up their IT offshore centers and they were serving clients across the world. So in these kind of cases, a client comes to a particular service provider or an outsource center, and they can set up a small dedicated center for themselves, or they can kind of use the available team to support them on different processes. And we'll talk about this as we move to kind of revenue models. So there are different revenue models under which these outsourcing centers works. But typically what we have seen is that these outsourcing centers have got the capability, size, scale to serve multiple clients at a given time and to support the clients across different business functions and business units. Just to kind of reflect in some of the key aspects which you can see on the slide, it can be implemented quickly. So considering that a lot of these centers works with a huge bench of people, so in case if they encounter a new client, they can really get that client onboarded very, very quickly and kind of put that into production. Then the processes are fairly mature and they are very experienced. The leadership, the team is pretty experienced. So the quality, the turnaround is far more better, and the overall setting up time is not that big in comparison to a captive center. And these are the centers which can kind of fits into all sizes. They are very effective in high volumes and very, very standard and repetitive processes. And again, if you, from an accounting perspective, Genpact is a big scenario, Accenture and Capgemini and all. So they bring their own specializations in terms of what they are kind of offering in terms of different business functions. So this is how the ownership models looks like. A very interesting data which kind of talks and depicts in terms of which is the biggest market for the offshore centers or these shared service centers. India is leading the chart, being closely followed by USA. USA is not kind of having their offshore centers, but it is predominantly the, what do you say, as the near shore or onshore centers. Then Mexico is becoming a big market nowadays, Costa Rica, specifically in Southern America. And then Philippines is coming a big time to compete specifically, again, from a time zone perspective and from a cost perspective. And Poland is a choice from the European market. So this is a kind of a landscape in terms of where India stands. I'll give you a kind of a quick reflection in terms of the order of preferences of the global market in terms of how they want to kind of see India as a market, or how they see India as a market across different industry sectors. So if you look into consumer, India is the market leader, energy, India is the market leader, financial services, and then telecom. Life sciences and healthcare is still India is not the preferred choice against America because of a lot of data confidentiality and the research aspects. However, if we look into the statistics, it's a very interesting thing. It kind of employs almost 1.3 million people across 1,400 companies. And this is the data which we kind of sourced in 2021. And the revenue generation, this market has kind of developed almost 34 billion USD in 2020. And the expectation is that the shared service centers are going to contribute almost 60 to 85 billion dollars in 2025. The key drivers for being a preferred location is low infrastructure cost, quality, talent, and accelerated digital connectivity. So I think this will set up the stage why this centers becomes so critically important, and why when we are auditing these centers, we have to be mindful in terms of what we need to take into the key considerations and how India is being structured at this time. Right. So with this, we will transition into our focus areas and the real topic of the day, which is the key considerations while we are auditing the shared service centers. The areas where we normally kind of see there has been a scope of the possible misstatements, and these are high volume, high transactional areas. So revenue, considering that it is the major driver over here, again, one has to kind of check that we are in compliance with the India's 115 wherever it is applicable, and with it will change, the revenue recognition will change with respect to the revenue models. And just to kind of give you a glimpse in terms of the revenue models, there can be 3 or 4 different types of revenue model, which is time and material model, that is one. The second is the value-based model in terms of how much value the shared service center is bringing on the table for the client. The third is the cost plus markup, and the other one is more in terms of the full time, where you kind of have the dedicated people working dedicatedly for those particular centers, and then you charge a particular amount and a premium on top of it. But depending on the revenue model, one has to be very careful once they're checking in the applicability of the Ind AS 115 and doing the revenue recognition, because it will change depending on the revenue model which you are going to fall in. The second thing is that majority of these transactions are related party transactions, because if it is a captive center, then it will fall under that purview. So one has to be very careful from a transfer pricing standpoint, considering that all the transactions needs to be done and accounted at an arm's length. So typically, there is a significant involvement from a TP transfer pricing standpoint, where we have to kind of, whether we are on a cost plus markup, whether we are in the related party transactions. So we need to kind of ensure that there has been a reasonable margin associated, and it is not just the transfer of the cost which is happening. So the third aspect is on the foreign exchange exposure. Forex, again, it plays a pretty significant role, considering the overall size and the operations which are majorly dependent in the global market. So you always see the Forex transactions every time whenever we are accounting for revenue, collections of money, and so on. So I think that is a fairly fairly important area where we have to kind of look for the overall accuracy, and that accuracy has to be kind of validated in line with the Ind AS 121. Employee cost. If you look into any typical shared service center, there are two major costs which sits on their P&L. The major cost is the overall support cost or the employee cost, which normally hovers somewhere between 50 to 55%, depending on which kind of an avenue you are. But typically, it is up north of 50%. The second major cost is the infrastructure cost, which predominantly takes care of the real estate. And then the third aspect is more in terms of the overall supports, the basic operational supports and others. So employee cost becomes extremely critical, because that kind of validates almost I can say more than 50% of the audit, because if you are doing a cost plus markup, then your revenue is nothing but it is just a kind of a markup on the cost. So you have to kind of take comfort on the cost, and that becomes relatively important in the shared service center. So the focus over here is very, very high on the cost side. And if the cost is majorly being defined by employees, so then it becomes imperative for us to kind of spend the maximum time on this area. And then again, from an applicability perspective, we have to kind of ensure the overall accuracy and the time cost allocation in line with the Ind AS 19. ITGC's information technology general controls. Considering that there has been a lot of involvement of the technology when we are kind of auditing a shared service center, so it becomes imperative for us to kind of ensure that there is an effective ITGC environment. And in the effective ITGC environment, we have to kind of ensure that our opinion is, as an auditor, kind of addresses that we have validated the ITGCs and they're working in sync. So we kind of comment on the design and the operating effectiveness of the controls when it comes to the ITGCs as well. This is a little heavier slide on the deck, but I'll kind of walk you through in terms of what exactly do we mean when we're kind of looking into the overall environment of the shared service center. I think it is important and critical for us as an auditor to understand the overall environment, overall structuring in terms of what and how this SSC is being created. So in case if it is a captive center, we have to understand the strategy and the objective of the parent company or the global organization, why they are setting up the shared service center, what is their objective, what is the business rationale, and what they want to kind of achieve out of this. Correct. This involves a thorough understanding of the roles, responsibilities, accountability, everything which relates to the decision makers and the defining the ownership structure of the SSC. We also need to kind of have a very clear understanding about the overall ownership and governance structure of the entity, the way it is being structured and the way it is being financed. specifically from a legal entity structuring in terms of how, whether it is being structured as an LLP in India, whether it is being structured as the private limited in India, how the parent entity is being structured, how the entire organization structuring is being done. So it is also important for us to kind of really understand the overall legal entity structuring of these SSCs, because that involves a lot of complications on the way from a taxation standpoint and from a FEMA standpoint as well. So processes, activities, and tasks that are transitioned. So we need to kind of really understand the processes which are getting transitioned from the parent or the global entity, whether it is a portion of the process which is getting transitioned, whether it is the entire process which is getting transitioned. So we need to kind of build our comfort levels around the process which is being transitioned. And in terms of how we need to kind of structure out our audit procedures in and around the overall process. So I think that's more in terms of the transition. The second thing is that the processes, system controls, accounting records, employees, state are relevant to the financial reporting. So this is imperative. We need to kind of make sure that whatever is impacting our financial reporting, we build our understanding in and around those areas, so that once we are doing the risk assessment and we are getting into the substantive side of the audit, we feel comfortable from our understanding of the overall structuring of the SSC. The selection and application of accounting policies, how they are recognizing the revenue, what all policies they have kind of taken into consideration for all their accounting treatment. So that is something which we have to kind of be mindful in before we kind of really get kick-started. That is there anything which is not in line? I think the next one is the risk associated. We have to kind of understand the overall customer base of the entity. This is majorly applicable for the outsourcing centers, not the captive centers, because in a captive center, you're only serving the parent entity or one entity. But in a outsourcing centers, which are kind of serving multiple clients across the board, one has to kind of understand the overall customer base of the entity, the type of arrangements with the customers, how they have been kind of entered into the contract. Is there a concentration of one customer on, say, 70-80% of your revenue is coming only from one customer and 20% of the revenue is coming from 20 customers? So those are the things which one has to kind of understand how it is going to kind of ensure the overall longevity of the organization, the sustenance of the organization, and how it might not impact the going concern of the entity. So the last thing is the transactions with the related parties. It becomes extremely critical, specifically once you are in a captive center environment. You have to kind of ensure that everything is being accounted for and there is nothing which is being missed on this aspect. So we'll talk about materiality. As I understand, majority of you would have been aware about how the materiality calculations are being done and why and how it is important for us from an audit standpoint. But for some of the new members, I will just give you a kind of a quick reflection in terms of what do we mean by materiality. Materiality is nothing but it is the way for us to determine the nature, timing, and extent of us being an auditor in terms of how we need to kind of gather the evidences to kind of get ourselves satisfied before we kind of put across an opinion whether the financial statements are free from misstatement or not. And the basis of selection of materiality becomes extremely important for us because that defines the entire course of the audit. How many transactions do we need to test? What and how much details do we need to kind of go in? What kind of a nature of transactions do we need to test, and so on. However, when we kind of calculate materiality is being calculated as a benchmark of few of the financial statement line items. It can be based on revenue, it can be based on profit, it can be based on expenses, it can be based on assets. But typically in a shared service environment, we normally recommend that the materiality benchmark should be either profit before taxes or total expenses. Cost is the major driver because your revenue is driven directly from the cost. So one can pick up the ratios. And the ranges, typical ranges which are being recommended are 5 to 10% for PBT in case if they're picking up PBT, and 1 to 3% for total expenses. And in terms of which range which should pick, we should pick 5, we should pick 10, we should pick 1 or 3. That purely depends on the state in which the organization is and your professional judgment as an auditor. Okay, we'll talk about some other avenues which we need to take into consideration when we are talking about the planning procedures. We have to kind of understand the overall background of the group which is setting up the shared service center in India. The second is that we also need to kind of understand the centers which are being set up in India more from an outsourcing standpoint. They are not the captive centers, but they are going to kind of support multiple different clients. We need to kind of understand the entire org chart, the promoter group and others. Need to be aware as an auditor what kind of announcements which the SSC is making from a time to time standpoint or time to time, so that we are aware in terms of anything which is more relevant, which should not go out of our context. We have to kind of also understand the key inputs to and outputs from the SSC, which are relevant from the financial accounting perspective, whether it is transaction flow, accounting records, the data. So considering in a layman language, the processing happens in these centers. The data processing happens in these centers. So when we kind of talk about the data processing happens in these centers, so it is what you call it as input data coming in and getting processed and then output going out. So we need to kind of really be mindful in terms of how the input is coming in, what is getting, how the input is getting processed, and what is the output which is kind of going back to the parent or another global entity, and how it is impacting us from a financial accounting perspective, be it in a cost, be it in a revenue, be it on a margins, be it on a transfer pricing, and so on. The other part, which it's not uncommon, which is not unique to this SSC, it is applicable everywhere, that we have to kind of ensure that we apply, we do our fraud risk assessment with a fraud triangle in our approach, where we have to kind of figure out what is an opportunity, incentive, and an attitude. From an opportunity perspective, can be a weak internal controls, poor process management, put on at the top. Incentives, if the incentives are driven through onshore expectations, so supposedly the onshore expectation is that we need to kind of get, say, a volume of 1 million transactions to be processed out of the SSC, and then if we are able to process 1 million transactions, the bonuses and incentives will be dependent on that. In that case, there is an opportunity or there is an incentive for the people to kind of really try and do things which probably can go in either direction. So incentives can be bonuses, personal incentives, as the way we kind of talked about. Attitude, again, if everyone is doing, why can't I do it? Upper management is doing as well. I've been treated wrongly, so I was not being treated adequately in the organization, so I've got a reason, a right to do it. So I think that phase, there is a lot of scenarios where we have seen the frauds happening. It reminds me of a particular example I used to audit in my early days, one of the biggest shared service center in the country. And as part of the audit, we used to kind of make sure that we spend, as I've mentioned earlier as well, as part of the payroll process. And within the payroll, there was a significant chunk of fees which was related to the reimbursements. Reimbursements were related to medical reimbursements. And it was a very interesting fraud which we kind of captured over there, wherein we identified that there was a kind of a benefit because that of that particular shared service center has an element of a call center as well. So people used to work throughout the day and the night. So there were a lot of incentives which are available for the people. And one of them was that you can go for a medical uh, checkup, and you can go for a medical treatment in any hospital, any nursing home. And it was not directly managed through the insurance companies. So you go, you take a treatment, put across your claim, and the company is going to process that. And as part of the process, we identified that there were a section of people who get eluded with a couple of small size medical departments, nursing homes, and they started creating the fraudulent bills in terms of the admission of their parents, in terms of their own admission, and so on. And by the time the management got to know, by the time we came across this, it was something where they have where almost 70 to 80 people were involved in this. So typically, when you talk about the fraud, it is normally what we have heard and observed is that there is only a section, one person or one department which is involved. But in this case, there were a bigger section. It was a spread across the organization. So why it happened? Because again, it is a very people heavy organization when we talk about the shared service centers. So you can imagine that the scope of the frauds significantly increase, the scope of misrepresentation significantly increases, and those are majorly driven at the staff level, the team level, considering the size and the scale in which they are operating. I think the last one, as part of our planning considerations, is that we have to measure and review the entity's financial health. So in terms of how they're growing, how they're doing their budgets versus actuals, what are the things which are working out in their favor, what are the things which are stopping them, and so on. So, and that's a kind of an imperative once we're doing any particular audit to understand the overall entity health. Now we'll spend some time in terms of some FS captions for the shared service centers. And again, I've deliberately picked up the avenues which requires maximum attention. Not all the avenues, so but these are the critical ones. When we talk about the profit and loss, the cost components, technology costs, these centers are really heavy on the technology because there is a lot of data which transfers from one place to the other. That is one. Second is that a lot of automation is now happening in these back office offshore entities, just to put automation into play and minimize the overall efforts. And then the third aspect is the R&D. So a lot of R&D activities happens, and that's where whether you're doing an R&D on the product or services, whether you're doing an R&D to develop your own software. So one has to be very careful in terms of reviewing the technology costs and the software development expenses. The second thing, which I mentioned it earlier as well, is the real estate infrastructure cost. So one has to take that into consideration that this is a pretty heavy cost which sits on the P&L. The third is the payroll, which is the biggest cost element on the P&L. Again, operational cost there is a lot of cost or expense which is being incurred on training and development and administration. And the third aspect is the staff welfare. So considering the benefits and the incentives which are associated in these centers, there is a lot of expense which is being incurred in the staff welfare space as well, and the overall training and development. Training and development can be in 2-3 different aspects. One is to get an expertise in terms of the area which needs to be performed. The second is in terms of the cultural diversity, because every center needs to understand how they need to work with their offshore or their onshore entity in Europe, how they want to work with the US entity and others. And the last is in terms of the overall upliftment of the individuals in terms of how they are growing in their career journey. So there is a lot of focus on the training and development, specifically in these SSCs. The second aspect, which is also one has to take into consideration, is the forex. Both the revenue and expenses can be in foreign currency, or revenue definitely it has to be, until unless you are serving as an onshore entity for an India entity itself. Profit or loss it gets transitioned in the forex as well, so that is another element. The other thing, and now kind of moving into the balance sheet equity, majority of the shareholders comprises of the promoter groups, promoters specifically in the SSCs which are being created in India, and the public if they are listed. But there are only a section of the shared service centers which are listed, but majority of the shared service centers are heavily promoter driven. So it's a fairly easier task over there. In terms of liabilities, majority of their fundings are met through equity infusion. However, considering that the payment life cycle in the SSCs is not as bad in comparison to some of the other industry sectors. So, and cost driven. So it's easier from a collection standpoint. There is hardly an AR which sits on the accounts. There are hardly any bad debts which happens and so on. So I think that kind of helps the organizations not to go for the major borrowing. So normally their overall cash management is fairly managed. In terms of liabilities, trade payables, considering that there are significant vendor payables which sits on the balance sheet, payables in terms of any particular loans, advances, and so lease liabilities. Since real estate is a heavy thing, and the stat dues. So stat dues is again a big thing. Again, looking into the overall size and scale of the people who work in these entities. Investments, they normally make investments in the equity instruments, and one as an auditor, we need to kind of check that for an impairment in case if they undergo something from a change in value perspective. Receivables, I think as I've mentioned that the receivables, it's not a big risk until unless you are working for a third party and the process has completely gone for a toss and you are not able to kind of proceed. But since the entire service is people driven, and you can't keep on kind of having the people for long term. So I think the maximum receivables, what I have normally seen, which have been sitting on the financial statement, have been for 2 to 3 months. So there has been hardly any provisioning for bad debts I've seen in these kind of companies. But yes, exceptions can be there. But yeah, majorly it is a safer zone. Unbilled revenue, that's a one big thing. Advances, prepaid expenses, balance with government authorities as part of security deposits, as part of the administrative fees. I think that's one thing which is there. The last thing is the deferred tax asset. It's again a big component of in terms of computing the overall deferred tax asset, which can be present through fixed assets, your ECL and others. Now we'll move to the risk assessment in terms of which are the key areas where we normally see there could be a possible potential risk, and how we address those at an assertion level, and what exactly we need to kind of respond as an auditor. The payroll assertions, which we normally kind of take care of, is completeness, occurrence. I'll not talk about cutoffs. It is predominantly applicable in majority of the ones, but considering it is a very, again, people-centric and staff-heavy organization, so increments given to people may be unauthorized at times, specifically that can be one of the risks where the approvals increments needs to be approved by the board. Appropriate trainings might not be conducted by the company. Risk of attrition is very high in these organizations. There's a lot of coaching which happens between one shared service center to the other shared service center. Leaves management, considering the size and scale, at times it becomes relatively difficult for the floor manager or the field manager to kind of manage the overall leaves. Proper segregation of employee duties and allocation of time, cost, and various assignments. It is a very, very critical thing in terms of how the people are being allocated on different assignments and different projects and how effectively they are billable. So, because the entire functionality of the margins and margins depends on the utilization of the people. So, in case of the people are not being effectively utilized, it kind of have a direct impact on the overall margins of these businesses. Right. The preparation of the salary sheet and the salary structuring, there is, considering again, there has been a lot of movement. So additions, deletions, capturing. So at times there is a big scope for a error or kind of an intentional misstatement in this avenue. To address those, we talked about increments needs to be approved by the board. Trainings to make sure that there has been a kind of an adequate training calendar so that the employee sees a growth in their career journey, and that helps in kind of managing the overall attrition. Proper leave approval process, the auditor should ensure a proper time cost allocation is being done because time, specifically when you're working in the N&M model, time and material model, there has been a lot of cost utilization happens from a client A to client B to client C. So one has to be careful that if a person is being allocated for, say 1 week or 2 weeks on a particular client, then the person is able to kind of complete that work within 2 weeks. And then before transitioning to the other client, the proper time charging has happened. So time charging becomes extremely, extremely important. Then the salary, it is the biggest avenue where the entire authorization needs to be in place. Majorly, these companies are very, very tech savvy organizations. So whether they are using PeopleSoft or they are doing Zoho or multiple other softwares. But having said that, still there should be a proper authorization and a matrix to kind of modify or make any changes in terms of the structure of the people. Okay. Moving to the next part, which is expenses. Again, from an assertion standpoint, we cannot check for existence, completeness, and occurrence. There can be a risk of materials purchased but not approved. So quotation for purchase is has to be kind of taken from all the suppliers, and all quotations needs to be compared once the order is in place, or the three-way match needs to be done. Unauthorized use of the Forex card, at times the payments are being made through the Forex card, so it has to be with only a identified set of people, and approval has to be taken before the handing over of the Forex card. Inaccurate, unauthorized rent payments, proper recording and the treatment of the rent as per the standard, and ROU and the straight lining. So at times we have observed as an auditors that the straight lining of the rent is not being done adequately, and that kind of takes a huge toll in terms of the impact which it kind of throws out. Necessary approvals. Again, these organizations are very heavy on travels. People at times travels to their global end to work and get that process transition from the global entity. So they go over there 1 week, 2 weeks, months, 6 months, long-term transfers. So travels are quite prominent, people coming into India and going out from India. So that also requires a kind of a key focus from a reimbursement standpoint, that it has to be in line with the limits, in line with the approvals as per the company policy. And there can be many more other couple of the expenses, but these are the ones which normally are heavy: the vendor payments, the Forex payments, your rent, and the travels. Intangible assets, existence, valuation, R&O, rights and obligations. So I think as we talked about that, there has been a lot of research and development which keeps on happening in these SSCs. So at times these SSCs are required to kind of develop the in-house softwares, and they keep on spending a lot on the technology, whether it is to serve the client, whether it is to enhance their own processes and procedures. So there has been a risk of under over capitalization of the software technology development. So the one thing which we as an auditors needs to kind of ensure is the proper allocation or proper accounting of these expenses, and has to kind of take also understand the competency and the skillful skills of the person who's being authorized to compute and capitalize the softwares or technology development costs in the OFS. So this can be another avenue. Period end processes, accuracy and completeness. Again, foreign currency balances may not be accurately reinstated in INR if it is in the shared service center is in India. There can be an off invoice which might be a miss. Write-offs are not completely computed or approved. And then all period end activities are not performed. So reinstatement of forex balance is a very, very important aspect. I think that has to be taken care of. What is the right rate which we are kind of applying for, whether it is for the month end, period end, and so on. Ensure that all the invoices are being done. If anything is not there, it's been parked in the unbilled revenue. Ensure that all the contracts and invoices tied to each other. The approval of the appropriate authority is present for all write-offs, whether it is debtors or creditors. Checklist for period end closing should be obtained. So all period end activity should there. I also normally suggest performing the MJVs, the journal entry testing. So JE testing is very important, considering that the volume of transactions which are being processed in these SSCs. So how you kind of ensure the overall journal entry processing methodology is something which is very, very important. Cash and bank, accuracy, existence, and completeness are those versions which we will normally cover, other than the cutoffs as well. The cash and bank payment voucher might not be approved. Bank accounts might have fictitious transactions. Fund might be invested in unauthorized sources. Online bank transactions might not be accurate. So it's a fairly simple thing. I think we are all, majority of us are comfortable in this aspect. So one has to kind of have an appropriate approval of the cash and bank vouchers. So proper BRS should be there in place. There has to be a proper approval of the appropriate authority for investments made. E-payments to be made by authorized personnel. I think there has been a significant kind of focus on the online payment. So that has to be approved and authorized by the right folks. I think in the cash and bank avenue, one of the things which at least I have observed being an auditor in the past is that at times the FIRCs, the foreign inward remittance, at times those are the things which kind of create challenges, because your funds are not getting kind of accounted for. How your transition kind of moving your funds from your from how the funds are being accounted in your bank account. So I think transferring them, making sure that the right declarations are being made from a FEMA perspective. So that is one aspect which is relatively complicated in this SSC audits. Revenue, accuracy, valuation, existence, and completeness. If you remember, I kind of initially mentioned that the revenue is not a major fraud risk area. However, in SSC, it becomes because of the various revenue models. So time and material based, milestones billing, outcome based pricing, transactions volume based pricing, cost plus markup. So different avenues are there. Cost plus markup is something where we kind of talked about that how relevant it is for us as an auditor to kind of, or how important it is for us to kind of ensure that the cost is being adequately accounted for, because your revenue is directly related to the cost. We'll talk about these models. What do we mean by time and material, milestone, outcome based, transactions volume, and so on. But this is the area where auditors needs to kind of address it by having a very detailed understanding about the revenue model and the streams, the contracts with all the major customers, whether the client is saying that I'm majorly operating on a T&M model, but your revenue contract says that no, it is not a T&M, it is an FT, full-time employee model. Similarly, if you are on a cost plus markup, the contract doesn't brings out that clearly in terms of what should be, how the markups are going to be defined and so on. So that becomes critically important. We also have to kind of ensure that all the performance obligations and contracts and recognize revenue based on the respective control transfers. So that is more from a revenue recognition standpoint. With this, we transition into the entity level controls. As we all know that we need to kind of ensure that the entity level controls are being designed and are being operating effectively. But a few of the risks which I want to kind of highlight over here, more prominent in the SSC industry. Annual operating plans and business plans may not be duly approved, and even if they are being approved, how the overall monitoring of the plans against the actuals are being done on a month-on-month basis. So one has to be very careful on that. Absence of process to review the budgets might impact the overall accuracy and reliability of the budgeting. Activities which might require an expert knowledge and insights may not be performed effectively by the organization if those are performed by the people who doesn't have that relevant experience. Lack of segregation of duties between incompatible functions may result in some duplication of efforts and increase the risk of improper monitoring of time costs. Recruitment may not be aligned with the requirements of the organization. In absence of that, you might kind of end up overhiring or underhiring or kind of hiring the wrong people. So these are the few of the things which come out as the entity level risk in the SSCs, but there can be many more. But these are the key ones which kind of comes across. Substantive considerations. Before we kind of get into the substantive considerations, I think we have been talking about these revenue models, and I want to spend some time on this. So the revenue in an SSC depends on the type of customer what we have, what is the nature of service, and how this entire arrangement is being done. So the simplest and the most heard of about revenue model is cost plus markup. That we are a captive center, again for the sake of discussion, we are a captive center of American Express, and American Express, we are kind of running the center in India. We are incurring costs all across the board. We get our transfer pricing assessment done. Basis the transfer pricing, we understand that we need to kind of ensure a markup of X percentage depending on the kind of services what we are rendering, whether it is an IT-based service, whether it is an accounting-based service, whether it is an administrative-based service. And basis those, we put that markup up and so say for example, our cost is 100, our markup, our transfer pricing study says that you have to kind of ensure a markup of 15. So we kind of bill it for 115, and that 115 becomes our revenue. In time and material based, it's a fairly simple. It's based on the projects on which we need to kind of allocate people. So supposedly there is a there is a particular project which requires people for, say, 1 week. They might be requiring people only on an hourly basis. They might be requiring people on a monthly basis. So in those cases, normally we have seen the time and material when we say that, okay, if a person is going to work on a particular project for 4 hours a day, then for 4 hours that person will be billed to that particular client as per the agreed upon rate. So agreed upon rate is nothing but that is a rate card which every organization kind of carries. So rate card is driven from a fact that how much cost the organization is supposed to kind of incur in a particular year, top it up with a margin, and then come out with a particular rate which is being distributed across levels, across set of people. When I say levels, levels means their designations and their experiences. So that is how the rate card being decided. So suppose again, there is a client which comes and says that I want my contracts to be reviewed, and I only want the support for next 5 days for you to kind of review my contract. So in those cases, then a person at an accountant level will review that particular contract and will be billed according to that. Outcome-based pricing, it's a it's an interesting avenue where the service provider charges based on the outcome. So in case if, and this is normally happens in the R&D facilities where probably there are a lot of things are happening. This is something which happens in automation, analytics, where there has been a lot of tech involved, not in a regular transaction processing avenues. The transaction or volume-based pricing, it's again a very interesting pricing or a revenue model, which says that as a company, as an organization, I know that I have got 1 million line items to process. 1 million line items to process in a particular, say, 6 months time frame. They give those million transactions to be processed to this SSC, and then SSC has to decide how much is going to be the time and the effort which will go behind this, and how many people they have to kind of put in that. So supposedly the SSC comes and says that, okay, for us to kind of process million transactions, we might need to have 20 people. And those 20 people are going to kind of work for next 6 months, and this is going to be the pricing for the overall contract. There might be a scenario that during the contract and given the volume, the 20 might be insufficient, the assessments might go wrong, and the company has to kind of, SSC might has to kind of increase that from 20 to 25. But in that case, those additional cost of the people will not get built back to the client. So this is called the volume-based pricing. However, in case if the volume gets increased from 1 million to 1.1 million, then there is always a scope in the agreement which says that if the number of transactions or the line items goes beyond 1 million, this is the additional rate which will be charged. It can be charged on T&M model. It can be charged on the team member model, which we normally call it as an FTE, full-time employee model. So full-time means where you have dedicated a person for a particular client for the entire year, and you say that, okay, this person is going to be working with you for the entire year, and this is the total cost for this individual, including your own overall margins. Not necessarily it has to be full year. It can be for 6 months. It can be for a month as well. But that's also one of the most look forward model in this industry. Moving into the substantive side, since we have got a fair reflection in terms of the revenue models, what we have, I'll kind of take you a little deeper in terms of what kind of audit procedures we need to kind of when we are kind of auditing for revenue. So we have to obtain all the contracts which are being entered by the entity and understand the key terms of the contract. We have to kind of there is always an MSA which is being there, which is a master services agreement, and it's being supported by an SOW, which can be a statement of work or an engagement letter or whatnot. So at times, your SOW is being repetitive for year on year, but your MSA is a kind of a master document, master agreement, which is being signed for the, say, period of 5 years. But your SOW is the one which will keep on defining the change in the the rate cards, some key terms, some key conditions, and so on, but your MSA will remain intact. So it is important, at least for larger customers, when we're doing that audit, we have to kind of go through the MSA first and then being supported by the SOW for that particular year, which is under audit. Model understanding, whether it's a T&M, milestone billing, outcome-based, volume-based, or cost-plus, it is important because that will help you to define in terms of what's going to be your audit procedures, which you're going to test for revenue. Identify the number of performance obligations if the billing is based on time and usage. So this is a relatively complex one because this is where you have to kind of ensure the correctness and the completeness of the base data used for billing. How the timesheets are being captured, whether the person is kind of adequately putting in the time into the timesheet. If somebody has kind of say worked for 8 hours, but has only charging 6 hours, so then practically there is a loss of revenue for the organization because they're only billing the client for 6 hours. Or it can be the other way around, that a person has worked for say 6 hours and has charged time for 8 hours. So those are the things which one has to kind of understand in terms of how strong are the entire controls and around the entire timesheet management and the people chargeability. TP reports, it's again one of the key aspects that we have to kind of understand how the transactions are being done with the related parties and whether they are at the arm's length or not. So that becomes important. We, as an auditors, also have to kind of obtain the FIRC's foreign inward remittance confirmation certificates for the inward remittances obtained to verify the overall completeness of the revenue earned in the foreign currency. So this is an additional step which kind of gives a comfort that the revenue ties with the amount which you have finally received in your bank. I think the last one is more in terms of ensuring the unbilled revenue. At times there is an unbilled revenue which sits specifically at the year end or the period end. So one has to be very careful in terms of testing for the unbilled revenue. Employee benefit expense. As we have talked, that it is majorly driven by employees, and there has been a lot of cross utilization of the people between departments, between projects, and there has to be a kind of a process where the auditors get a kind of a comfort in terms of the proper allocation of the time cost of the employees for a particular project. However, the key avenues apart from this, what we have kind of tested is the payroll analytics in terms of how the numbers are moving, whether they are moving in line with the growth in the staff headcount. Is there any kind of a red flags what we have been observing in terms of the overall growth? At times there are multiple retention schemes which are being introduced by these SSCs because there has been a lot of coaching. There's a lot of people who keeps on moving between these organizations. So there has been a lot of retention schemes which are being introduced from a time-on-time basis. It can be a retention scheme for a long term. It can be a retention scheme for a particular project, for a particular timeline. So one has to, as an auditor, one has to kind of understand the entire bonuses, retention, incentive schemes, and then ensure the overall accuracy of the provisions in the books which have been made for these areas. Actuarial, specifically on leave encashment and gratuity. So again, it is in itself, it's a kind of a big audit procedure because the volumes are so high and heavy. So one has to kind of ensure the data which is being sent to actuary is adequate. The assumptions which have been taken into consideration by the actuary are in line with how the businesses are operating in a similar in the market. The third thing is the overall calculation of the data. So how the data is being computed, it's also very, very important in terms of how it is being kind of taken, whether it is the carry forward of leaves, whether it is the overall leave encashment payouts and others. So a little bit on taxation benefits on exporting. We normally recommend that all these companies should have a kind of a proper tax consultant and a tax advice should be taken into consideration. And as an auditor, we should also kind of do our confirmation procedures with the tax consultant of the organization and a parallel kind of a consultation from our tax specialist teams or our tax specialists. However, having said that, at one point of time, it used to be a big area where all these EOUs, SEZs, the tax exemptions were there, but slowly and gradually, as there has been a kind of a sunset which is coming into play. So this is not going to be a kind of a big area, but still the companies which are still operating under the tax incentive regime, they there we need to make sure that the entire taxation calculations and the benefits are being taken into account adequately, and that has to be supported by the tax specialist. The other thing which probably it kind of reminds me again, when there has been a significant amount of legal cases, what we normally see in these SCs, and those legal cases are normally pertinent to the employee related legal cases. It can be workplace harassment, it can be more in terms of the claims, reimbursements, and whatnot. So that is one aspect. And the second is at times you kind of see the legal cases in relation to the income tax, again, more from a confusion in and around the tax benefits and the regime. So one has to be very careful, has to spend a significant amount of time on that aspect as well, in terms of how the provisioning needs to be done, whether it has to be parked as a contingency, whether we need to kind of treat that or not. So that's another area of consideration. So receivables, specifically in the related party environment, one don't has to kind of rely only on the confirmations which are coming through verbal clearances. It has to be documented, even if it is coming from a related party, and it has to kind of have been adequately. It has to have a proper documentary evidences behind that. Foreign currency balances. Since we've talked about that these companies are the ones who kind of really expose themselves into the forex, the reinstatement becomes extremely important at the period end of the year end. The auditor needs to kind of understand the FEMA guidelines, RBI remittances, to ensure that the entity does not have any legal non-compliance issue. So that is also important in terms of how one needs to be taken into consideration. And for this, again, this might not be an area of expertise for the auditors at times. So there's no harm of kind of taking an opinion from an expert consultant. Operating costs becomes very, very important in a cost plus markup model where the revenue is directly driven on costs. So we need to kind of put a lot of focus on this area. So we normally spend a good amount of time on the overall cost and ensuring the completeness of such costs. The second thing is the treatment of the specifically the technological expenditure, development of softwares, where it has to be capitalized in accordance with the Ind AS 16 or Ind AS 38, depending on whether it should be an intangible asset or not. Consolidation of accounts. There has been a significant exposure on the consolidation, because if you are running a shared service center and you're supporting, say, multiple entities across the globe, or similarly you have got multiple entities across the globe operating on a shared service model. So this entire corporate structure requires one to kind of ensure that the consolidation is happening in the reporting entity, in the currency of the parent entity, not only in the currency, but the applicable gaps should be taken into consideration. So at times, as an auditor, we might need to kind of give our opinions or our clearances on two different financial statements, one for the parent entity, one for the local compliances and the local statutes. So that is another thing which requires a lot of our attention and time. So consolidation, at times it's complex. I've seen consolidation happening across 5 different business units with 5 different currencies as well. So far, just to kind of recap few of the things, we kind of started with the planning. We kind of get a little deeper into the risk assessment again at an area level, and then we kind of talked about the financial statement captions. We talked about assertions and what kind of a risk normally we see. Then we kind of talked about the different types of revenue models. And then from there on, we kind of got into the substantive procedures in terms of the revenue models, that what kind of a substantive procedures we need to kind of take into consideration for different key areas on the financial statements. So now we are moving towards the last part, which is audit documentation. And as we all know, it is the most important aspect. Audit work not documented is not done. So audit documentation should definitely mention the scope, purpose of the work paper, the procedures what we perform, and the conclusion on what we have, how we have closed that particular area or work paper. So following areas which one has to take into consideration when we are kind of documenting things: understanding of the overall entity and its environment, which we talked earlier; risk assessments, the identified risk, whether it is an inherent risk, significant risk, broad risk, what are the procedures which you have performed as part of the risk assessment; the walkthroughs which you have done for different processes; as part of the process understanding, identification of the risk, and the controls which are being mapped against those risks. Documents around the entity level controls. We need to kind of understand once we have to kind of document our understanding of the entity level control. All the work papers should tie with the financial statements over and above once you kind of mention your scope and purpose. And then agreements with the major customers has to be taken into account. We have to kind of keep the copies and the documents to support our comfort on the overall revenue. Any accounting opinion, this has been taken by the company or by us as an auditors. And then documenting the transactions with the third parties which are at arm's length. Tax experts involvement can be there, and so that brings us to kind of the understanding of the tax expert. We also have to kind of take the legal opinions for the legal cases, and then the management representation letter in terms of the key areas which are being done as part of the audit. So yeah, that's a kind of an overall view, but just to quickly reflect back on from where we started and what all we covered. So we talked about the shared service center, an overview in terms of what kind of a different shared service centers are there. Ownership models, we talked about whether it is a captive center or it is an outsourced center. The global landscape, how India is being currently positioned and how the market is looking like in the near future, can be a potential market of $60 to $85 billion in 2025. What are the possible misstatements in the shared service center? We talked about the 5 areas and the possible misstatements. One was revenue. Then we kind of talked about Forex, payroll, ITGCs, and the planning procedures, which we kind of talked about, that how we need to kind of build our overall understanding about the entity. And then we kind of got into the major financial statement captions, where we had tried and understand that what all major financial statement captions are there, whether it is payroll, expenses, and the revenue, and what kind of a risk do we normally foresee in these captions, and the response and how we need to kind of really mitigate those things. We briefly touched upon entity level controls. Then we're going to move into the revenue model and the key substantive considerations for the major FS items. And then towards the end, we kind of concluded with the journal audit documentation. So again, it is a fairly high level stuff, but again, it's a very interesting industry to audit. At least I have audited this for good 7 to 8 years, and then I myself is kind of running these offshore centers for last 10 to 12 years. So it's always being exciting to kind of really understand the business dynamics, being an auditor and being the person running the business on this side as well. So with this, I'll kind of try and rest my thoughts and views over here. But happy to kind of take up a few questions in case if there are. Anilji, do you mind facilitating in case if there are questions?
Thank you so much, sir. Thank you so much for such a wonderful deliberation on this topic relating to the shared service center. I have received 2-3 queries, sir. Sir, first question is how to fix proportion of cost among the companies unlisting these services of a service center, or can
Your
it
voice,
be based on the service?
Anilji, your voice is not coming out clear. You need to be little either closer.
Okay. How to fix the proportion of cost among the companies utilizing the services of a service center?
So if I can understand the question correctly,
आगे भी है sir, or can it be based on the services received by the company on item wise or piecemeal system fixed by the service center?
Yeah, I think it's a difficult question for me to kind of understand, but whatever I'm able to understand from a question, it says that if I am a company which is say based out of anywhere, and I am taking the services from a support center, SSC, which is an outsourcing center, and they are rendering me 4 kind of services. One is the payroll services, one is the IT support services, one is the accounting services. In those cases, how should I kind of apportion the cost from in my P&L, because it is going to be my cost and it's going to be revenue for the SSC. So is my understanding correct on the question?
Yes, sir.
Okay. So I think it is a fairly simple aspect, at least until unless there is any kind of an element which I'm missing from a complexity standpoint, but fairly it is going to be driven directly at the business unit level or the service level. So normally in the shared service centers, their P&L are being divided at a BU level or they are being divided at a service level. So normally they don't overlap with each other, and it is a fairly fair allocation which you will see from an invoicing standpoint as well. That you will see an invoicing coming for the HR services, you will see an invoicing coming for the tech services and others. However, it is also important for us as an auditor to really understand in terms of how the MSA and the SOWs are being designed. So MSA might say that we will do A, B, C, Z work, A to Z work with a company X in India. However, an SOW says that we want to have a separate SOWs for work A, work B, work C, work D, work E. In case if you have got different SOWs for A, B, C, D work, it makes the life easier for the organization because then everything is being driven through SOWs and the invoices are being done separately. But if again the SOW says it is silent and it says A to Z, and the rate cards are going to be this for service A, rate card for this is going to be service B, then one as an auditor has to kind of really ensure that how the invoicing is being done if you are representing the client, and similarly you need to kind of ensure how the invoicing is being done if you're representing the SSC as well, that you are kind of capturing the right rate cards for the different services. So just to again put it in a layman word, it is going to be fairly simple at a service line level.
So one member is asking, in a gist manner, what are the mandatory annual certifications for audit to be carried out in respect of shared service center?
So in which manner? I'm so sorry, I missed the first part.
mandatory annual certifications and audit to be carried out in respect of shared service centers. What are the mandatory?
So I think this is predominantly, I would like to kind of one is depending in terms of the structuring of that particular shared service center. The few certifications which are important. One is the data privacy, which is again a very, very important standard certification, which we need to kind of take. SOC certification. SOC is again third-party compliance certification. If we are a third party supporting another client, specifically working for an outsourcing center. So SOC certifications comes into play. Then our compliances, I would not say certifications because that depends on the compliances. So that compliances can be with FEMA, that compliances will be with the tax authorities. And these are the major ones which comes to my thought process at this time. Yeah. But
Yes.
data privacy, SOC certifications are extremely important because without that, even you can't even go and pitch for work in the market. And
Yes.
then your respective audits and everything which keeps on coming in play.
Sir, what should be the ideal method of charging of expenses incurred on staff training of shared service center, which is substantial on time basis or assignment basis?
Very, very good question. I think time basis or assignment basis is dependent on the kind of a client what we are doing. So supposedly, I'll take up an example that if we are a captive center and we are only serving our parent entity or one of our global entities, then the time basis is reasonably okay because then you need to kind of distribute your training expense over the period. And you know that at what time you're incurring that expense and at what time you can charge that. If it is that we are doing a specific, say, certification training, if we are doing, say, Six Sigma training only for a particular client because it is a client's requirement or it is a project's requirement, then that cost has to be charged on a project basis.
G. Sir, in the case of for revenue model, whether minimum and maximum rate is applicable? If yes, what is the criteria?
Yeah, again, it's a minimum and a maximum rate. It's a very interesting question. I would rather say that it can be viewed in a different format. So let's take it for the sake of easier understanding. An example that we are talking about a revenue model, which is a TNM model, right? And on a TNM model, there is a person who is at an accountant level. So at an accountant level, there can be an accountant which is coming with a 1 year experience. There can be an accountant which is coming with a 5 years experience. So for a 1 year experience, the rate is going to be different. For a 5 years experience, the rate is going to be different. However, in some cases, that the organizations define the rate card at the particular designation level. So supposedly there is an accountant, whether it comes with a 1 year experience or a 5 years experience, the rate card is going to be a blended rate. The second change in the rate will happen at a senior accountant level, who's say 5 years to 10 years. So then they will apply a blended rate as well. So in those cases, how the rate card is being done, either you will have a rate card for accountant 1, accountant 2, accountant 3, accountant 4, and accountant 5 spread across 5 years, 5 different rates for 5 different people. The other way is the blended rate of 5 different levels for accountant from 1 to 5, which says that, okay, my blended rate is say $10 instead of having $5, $7, $9, $11, and $13. So I'll go with a blended rate of $10. That is one way of doing the rate card. The min and a max can be addressed within that as well. The second aspect of looking into the min and the max is the seasonality of the business. So suppose majority of the work in this scenario is recurring, but at times there is a seasonality work which kind of flows in. So you see a lot of work kind of coming in the time period, which is January to March or April, where these global entities goes for their closures. So you see a lot of work coming at that time. So you might have a kind of a seasonal rates wherein you give some kind of a discounting in the off season and you kind of spike up your rates in the season. So that is where you can kind of play with the rate card. But there are multiple ways and means to kind of look into the rate card. Whether you should charge at a min and a max cannot be answered as easily unless you kind of get a perspective of the client and the nature of services what you're rendering.
Ji, sir. Sir, can you throw some light on the case shared by you regarding the fake medical bills reimbursed by the employees? Since the employees must have shared the bills from the hospitals, which must have been signed and stamped. Can you please walk through about the process which is to be adopted?
Yeah, I think what was happening in that case is that suddenly there were 2 or 3 medical institutes from where, or hospitals or nursing homes from where the organization started seeing a lot of bills coming in, and normally the bills were kind of a particular disease or a particular concern, and that is what it triggered the organization to go for a next level of inquiry, to speak directly with the hospital and nursing home to kind of understand that whether this person has really been admitted or it's being really being done. So it was a kind of a collaboration between the employees and couple of people from that hospital management who kind of condued it to get into this kind of fraudulent activity. So as an accountant or as an auditor, one has to kind of really ensure that how you are seeing these things, what is the frequency of such expenses coming your way, and whether at times when you're looking into the invoices and things, whether they look legitimate or not. At times you might not be able to kind of make it out from the invoices, but it is more of a trend when you do different substantive analytical procedures. That is a time when you are able to kind of capture few things. Though being an auditor, it is extremely difficult for you to kind of identify fraud, but it's majorly the management who is doing the accounting on a day-to-day basis. They are the first ones who kind of capture those things. But yeah, that is exactly what happened in this particular case.
Yes, sir. So, sir, thank you so much. We have come to an end. We have received these queries. If I receive certain more queries, then I'll forward it to you through mail. Then I'll receive the feedback. Then I'll forward it to the concerned member. So
Sure.
thank you so much on behalf of AASB of ICI, sir, for sparing your valuable time and enlighten all of us on various considerations and various things which are required while auditing this share service center. So once again, thank you, and thank you for sparing your valuable time and acceding to our request on a very shorter notice, sir. Thank you so much, sir.
Thank you for inviting me. It was all a pleasure for me. Thank you.
Thank you, sir.